Did you know that sometimes the bond market whispers things even before the headlines do? The bond market can sense what even the government or the Reserve Bank of India hasn't said out loud yet. If you enjoy learning about how the real economy works beyond the noise, subscribe to this channel. Because here, we decode finance in a way that's smart but simple. Right now, there's something interesting happening with India's government bonds. Investors are demanding a much higher return for buying 30-year bonds compared to 10-year bonds. In fact, the gap between them has jumped to 77 basis points. That's a big signal. But what is it really telling us? Let's break it down simply. When the government borrows money by issuing bonds, it promises to pay back after a fixed period, like 10 years or 30 years. Investors who buy these bonds get regular interest, called the yield. Now, usually, the longer the government takes to pay back, the higher the yield, because more time means more risk. That's why a 30-year bond should pay more than a 10-year bond. So far, so good. But here's where things get interesting. Recently, the Reserve Bank of India cut interest rates, and that changed how investors view the bond market. This made short and medium-term bond yields drop. For example, 10-year bond yields either stayed stable or dipped slightly, but 30-year bond yields didn't fall. In fact, they rose a little. So now, the difference, the spread between the 10-year and 30-year yield has become much bigger than usual. That's what we call a steepening yield curve. But why is this happening? Because investors are getting nervous. They think the government might borrow more in the future to fund spending, especially if oil prices rise or if exports slow down. These are long-term risks. So, to protect themselves, investors are saying, we'll only give our money for 30 years if you pay us a lot more interest. In simple terms, the bond market is saying, we don't fully trust the long-term picture yet. The steepening of the yield curve is important. It doesn't just affect big banks or institutions. It can also affect long-term loan costs, pension returns, and even the way the government plans its budget. For example, if the government wants to raise money for infrastructure by issuing 30-year bonds, it now has to pay more interest, making projects more expensive. So, what can we learn from this? The bond market is not just about numbers and graphs. It's about trust. And when the gap between 10-year and 30-year bonds suddenly grows wider, it's often a sign that investors are asking tough questions about the future. It doesn't mean panic, but it does mean pay attention. If you're someone who wants to understand how money flows in the economy, this small detail, the 77 basis point spread, isn't small at all. It's a quiet message from the people who move billions every day. The curve is steepening, the future is speaking. Are we listening? In the world of finance, the bond market doesn't shout. It whispers. And right now, it's whispering something big. The curve is steepening. The risk is rising. And the future is watching to see who's paying attention. If this helped you see the market a little differently, give it a like. And if you want more stories the numbers are trying to tell, you know what to do. Subscribe. And stay curious.